$7.2 trillion. That's the amount of cash sitting on the sidelines of the stock market, and it just hit a new all-time high. That's bigger than the entire economies of both the United Kingdom and France combined, and it's growing fast. It's jumped by $2 trillion in just the last 2 years. To put that in perspective, it took 20 years for this cash pile to grow by the same amount between 1981 and 2001. This colossal sum is stored in money market funds, low-risk safe havens, including cash and treasuries, where investors park their money while they wait for better opportunities. Yes, a big pile of dry powder sitting on the sidelines just waiting to rush back into the market might sound bullish to some people, but history may actually suggest otherwise. For example, money market funds grew quickly in the late 1990s, leading up to the dot-com bust of the early 2000s. And less than a decade later, these funds grew at an even faster pace, reaching record levels just before the 2008 housing bubble and Great Recession. And then in 2019, leading right into the pandemic shock. 3 recessions preceded immediately by rapid surges in cash on the sidelines, and we're seeing it again today. So how do we look at this? Is it a bullish sign, dry powder ready to fuel the next rally, or is it a bearish warning of an impending downturn? To find out, we first need to understand why investors are fleeing the market for cash. It turns out they're making a rational decision based on 2 things: what they can gain from holding cash and what they risk by investing it anywhere else. Elevated short-term rates have made money market funds significantly more attractive than usual. Just look at this chart comparing the US inflation rate to the federal funds rate, which dictates short-term yields. Notice how the Fed funds rate is higher than inflation and has been for over 2 years. It's now sitting at 4.3% compared to 2.4% for inflation. Even despite recent Fed rate cuts, these yields on money market funds remain attractive. It means investors can park their cash in a risk-free asset and see virtually guaranteed returns of more than 2%. That's a pretty attractive deal, especially in a risk-off environment like we see today, when economic policy uncertainty is so high. And it's a stark contrast to 2021, when returns on cash were 0% and inflation was 5%. In that scenario, there was no incentive to hold cash, and money sitting on the sidelines really was just collecting dust. Here's another way of looking at it. If you take the inflation rate and subtract the Fed funds rate, you get the ratio between them. When this line is above 0, it means that the Fed funds rate is higher than inflation, and yields on cash are more attractive. Notice how growth in money market funds tends to flatline when inflation outstrips the Fed funds rate, like it did during this long period from 2010 to around 2019. And money market funds tend to take off in the opposite case, which is what we've been seeing since mid-2023. But there's another reason that so many investors are holding out. They might be waiting for better opportunities. Right now, there's a perceived lack of good alternatives in the market, and that's keeping a lot of value investors on the sidelines, and they may have a point. Equity valuations are through the roof right now. Just look at the famed Buffett indicator, the ratio between stock market cap and total GDP used to gauge whether the stock market is overpriced or not. It's currently sitting at 200%, meaning the stock market is valued at twice the size of the entire US annual GDP. That's the highest level ever, around 2 standard deviations above the historical trend line. And to value investors like Warren Buffett, this implies that some of these companies are too big for their britches and may be due for a correction. This potential overvaluation makes taking a bigger risk on the stock market much less attractive than the higher than usual yields on cash. But there are other places investors put their money in a risk-off environment. One of them is real estate, but the housing market is notoriously expensive at the moment, with high barriers to entry that make it far less appealing than cash. 30-year mortgage rates are the highest they've been since 2006, just before the housing bubble burst. That makes housing very unaffordable for new buyers and prices people out of the market, leaving cash as a viable store of value. These 2 reasons, attractive yields and unappealing alternatives, explain why investors are piling up so much cash outside the stock market. But this brings us back to our main question. What does this mean for the stock market? To answer that, we need to look beyond the surge itself and take a look at history. For example, look at this chart showing money market funds in the S&P 500. As you can see on this chart, during the 1980s and 1990s, both the stock market and money market funds rose together. This makes it clear that this isn't a zero-sum situation. Cash can pile up on the side while the stock market booms. It's happened before. There are other similarities that back up the bullish case, because for most of that time, the Fed funds rate was significantly higher than inflation, like we see today, so cash was an attractive asset. That means investors saw money market funds as a good addition to their portfolios, diversification to literally cash in on risk-free returns while continuing to invest in the stock market. So while a surge in money market funds can seem like a risk warning, and sometimes is, the current context of attractive, inflation-beating yields provides a logical reason for investors to hold cash. But that leaves us with a bit of a split psychology in the market today. The elevated valuations shown by the Buffett indicator has driven a lot of risk-averse investors towards cash as a safe haven, as they await better opportunities in the market. But at the same time, risk-tolerant investors are still chasing upside in the stock market and other assets like gold and Bitcoin. To really understand whether it's bullish or bearish, we have to consider what could tip the scales one way or the other. That brings us to two potential scenarios, the bullish and the bearish case. If the Fed continues to lower interest rates and the stock market continues its recovery with low volatility, we could see investors begin to dip into that $7 trillion cash pile to take advantage of higher returns in a more risk-on environment. This would resemble those 1980s and 1990s periods, where cash and stocks rose hand in hand, turning the sidelines money into fuel for a rally rather than a downturn signal. The other possibility is that the Fed maintains higher for longer interest rates, which is likely in the near term, and the stock market fails to fully recover. If the S&P begins to consolidate or decline again, we could see a further buildup of cash on the sidelines, and the scales would tip more towards a warning sign scenario like we saw before the dot-com or housing bubbles. At Capital.com, we'll keep you posted on money market funds and what investors are doing with all that money, along with major market trends. Hit like and subscribe to stay tuned. Thanks for watching.